Hi there, my name is Gery and I am the Chief Options Expert at TanukiTrade. And welcome to another episode of Options Scenario Lab, where the goal is to show you how different option strategies work in the same market environment. Right now, what I was thinking is comparing a diagonal spread with a calendar spread on SPX. If we are looking at the SPX chart on TradingView, what we can see here is that I set the GEX profile to 16th of January, which is the next weekly expiration. And here clearly shows that the 7,000 is the highest net GEX core resistance level. On the upside, we are above HVL line, which is the blue line here, which means that we are above the high volatility level, and 6,800 is the put support right now. And as you can see, the market is climbing up since the start of the year. This was the first candle of the year, but since then, this week, the market is bouncing back up. And what I would like to show you is two strategies which target the 7,000 as the price target or as the short strike of the strategies. And right now, the market is approaching the previous high, which can act as a resistance from a technical side. And it also is around a second core wall in terms of net GEX values. And the primary one is 7,000. So let's see what kind of option strategies someone might look at in this environment. Right now, there is a special case in terms of time spreads, because usually I trade the Friday to Monday time spreads, but right now, because of the holiday of the January 19, there is no Friday to Monday expiration combination. There is only a Friday to Tuesday, which sometimes behave a little differently. But here you can see there is an backward dated skew, which means that the front month has higher skew, higher implied volatility than the back month. So I will show you two separate Thinkorswim Analyze tab where we can see the strategies and we can compare them. These are two time spread strategies for SPX. On the left side, you see a diagonal spread. On the right side, you see a calendar spread. The only difference between the two spreads is the strike combination, because the diagonal spread has a short strike of 7,000 and 705 as the long strike. That's why it's a much cheaper spread than the calendar spreads, where I buy and sell the same strike on the same expirations, January 16 and January 20. As you can tell, the price is 3.75 and here's 1.95. So this is almost double the price. Actually, right now it's double. So let's lock them down as if it was executed on a live account, and from here we can continue to monitor these trades. And let's lock the price down. This is exactly twice as the diagonal spread. And the other difference is that you can easily see is the flat delta nature in the diagonal spread, and in the calendar spread there is a positive delta. So this is a more bullish setup in terms of delta than the diagonal spread. But for the diagonal spread, you pay less for less direction. Here, you pay more for a higher directional bias. So if the market gyrates around this area and does not pass very quickly the 7,000, the diagonal will be doing better probably than the calendar spread. The calendar spread needs to move. If the market moves to 7,000 in a couple of days, this might make a loss if it goes too fast. If the calendar spread goes fast, that makes more money. This is what I would like to compare in this option scenario lab in the next couple of days. If the market rejects this level, so bounces back from the previous high, that would create a better environment for the diagonal spread, because that has a flatter delta. So this is more resilient in terms of neutral or sideways movement than the calendar spreads with the same target strikes. So this is what I would like to track or monitor from now on. So let's continue from here. I'm back again. It's Wednesday. I started this simulation yesterday, and as you can tell from the daily price chart of SPX, there was a new all-time high right now today, but the market rejected it so far. The GEX levels did not really change significantly since yesterday. The highest GEX level stayed 7,000, and the most important put support went a little bit above 68.25. And let's look at the two positions. And the only thing I changed since yesterday is not an adjustment, but I wanted to have the same downside debit on both strategies. So if I go in here, I want to see $380 and also $380 here, because the diagonal was half the price of the calendar spreads. So that's why I changed the contracts from 1 to 2, just to being able to compare the profitability and the loss. So right now, what you can see on these expiration lines is that the calendar spread has higher delta, obviously, because it also started with higher delta, and this is a lower delta. And right now in the diagonal spread, we have around 80 bucks annualized P&L, and this is only 20 bucks, because this is more resilient if the market is staying sideways or going down. Right now, what we can see from the daily chart is that it's not really going down since yesterday, because there was an all-time high today. We are just going back to where we started. And in this case, if the market is gyrating around this level and going back to where we started, this one is more resilient and makes more money in the short run. This is more directional. So the break-even on the calendar side is closer than on the diagonal side. If the market stays around this area, diagonal will be better. If it goes up and targets the all-time high again, or maybe the 7,000, then the calendar spread will be much better. So this is the current state of the two positions. I will continue from here. I'm back again. It's Thursday. Let's look around the SPX and what's going on. Right now, what we can see is that the GEX profile did not change except the HVL, because the HVL line yesterday was 5 points lower. And right now, what you can see on the daily chart is that the market was testing the HVL line, and since then it's rebounding, as we can see. Let's check out the 50-minute chart. You can see that the market tested the HVL line, and since then it has been rebounding. I'm not sure what the end of the day will be, but let's look around the two positions and how they compare to each other. What we can see is that the diagonal spread has a higher profit because the calendar spread is in a losing state. What someone can do in a situation like that, if somebody is, afraid of that the market will turn down. But actually, if we look at the technical side of the whole thing, we are above the HVL line, and we are above or around this area where the market, there was a resistance here, there is another resistance, and here was kind of a support kind of stuff. And right now the market is sitting on the HVS, so I expect that it might go back up. What we could do in a calendar spread, for example, if I'm afraid that the market will go down, is make it like a diagonal. So for example, in this case, what I would do if I wanted to have it done is buying back the 7,000 and shorting the 6,995 and getting like 150 credit for it. And as you can tell, this would create a diagonal with 5 strike differences. So that would create lower loss potential on the downside, but also lowers the delta significantly, because if you look at the calendar spread, that has a 2.5 delta right now, and the market price is here. And if you click with this adjustment, it creates around flat delta. So that's one thing someone can do. We can track this as a potential adjustment. And if we are also afraid on the diagonal side and want to lower the potential loss if the market turns down, we can do the same. But then it will become a 10 wide diagonal, because remember, we opened the 7,005 as the long strike, and right now we will make the short strike 6,995, and that would create a 10 difference between the two strikes. So if I make this one, for example, with one contract, only half of the contracts, that also would create a very flat diagonal, very flat delta diagonal, and lowering the downside loss amount. So we can do that just to make sure that we have the same price here. I set it to 150. And right now what I did is lower the delta for both of them. They have different downside loss, obviously, because of the calendar has higher. But what we also could do is, for example, to 169.90, and that would create a negative delta. So again, it depends on the trader. If someone wants to have negative delta in a market like that, you can do it easily by adjustment. But right now I wouldn't want to see negative delta, so I'm not opening up it to a 10 wide difference on the downside. So this would create a much more potential stuff, I would say. So these are the two positions right now, and let's monitor these adjustments in the next coming days and also compare the strategies if I did not do anything or if I did not do any adjustment. That's also very interesting how they both behave in the same market environment. We can see as the current market price is that diagonal is making money, or at least it's break even, and calendar is losing money because of the higher delta directionality. With adjusting them, they are both flat delta, and wants the market to gyrate or move around this area, not move very much. So this is what we will track from now on. Let's continue from here. I'm back again. It's Friday. Let's look around what the market is doing right now. As you can tell, the S&P is rising, and yesterday I mentioned that there might be a possibility that the market will turn around from the HVL line. This is what happened exactly. And right now we are approaching the 7,000 core resistance, which might reject the price at the first try, but we will see. And since this move is a little bit too fast for the diagonal spread, let's see how they compare to each other. Here you can see the diagonal spread, which is around $80 in profit, and this one is around $19.95. The calendar spread is doing obviously better because of the higher delta. This negative delta will obviously turn to positive if the market stays here because of the charm and the time decay effect of delta. And let's see what would have happened if I adjusted both positions like I did yesterday. Because yesterday there was an adjustment made by risk management purposes if the market turns around, just to see how they compare. And right now this has a higher negative delta than this one, and this would be around $30 loss, and this is around $10 or even break-even kind of territory. So they are somehow very close to each other, but this looks uglier because of the higher upside potential risk, obviously. So this is how it's going, and the best thing would be for both strategies if the market stayed around 7,000 in the original state. But if we had done the adjustment, that's also fine if the market does not rally above 7,000. The expiration is next week, January 16. So if the market is not shooting very fast above 7,000, both strategies in this simulation will become profitable at expiration. But I usually do not hold on to expiration when I'm trading diagonal spreads or calendar spreads. Right now it's very violent. You can look at the 15-minute bar, and it's just moving and moving and keeps moving, and it's not turning back. So I would assume that 7,000 is in a very, very short time we will reach it. Maybe today, it's not out of question, but if nothing else happens, Monday will be probably above 7,000. And then we need to think about the adjustments, possible adjustments, or just closing down the position. It depends on how much it can gain during the weekend. So I will continue from here. I'm back again. It's Monday, and right now what you can see on the SPX daily chart is that the market keeps continuing higher. The 7,000 core resistance is pretty close to the current market price. And let's look at the two positions, how they compare to each other. Right now what you can see is that the original position without any adjustment And they are both still in a very nice profitable state, but you have to note something that changed since my previous recording. If you look at the IV skew, the implied volatility skew, this is the implied volatility skew of the original position, which tells you that the short leg has 11% IV and the long leg is around 9% IV. So that's the difference is 2 percentage points. And if you go back to my previous recording on last Friday, you will see that there is only 1 percentage point between the two. So it means that the front month or the front expiration, this one, which expires this Friday, will have a higher IV and the skew widen. That's why the time spreads are not opening up. This is called opening up. When the skew is going against you in the front month, then the calendar spread or time spread tends to not opening up very quickly. Usually there is a reason for it, and right now the reason is that we are on a Monday, and on Tuesday and Wednesday there will be two very important market events. On Tuesday we will have CPI, on Wednesday we will have PPI. So that's why the market is keeping, quote unquote, keeping the volatility in the front expiration, and that's why it's not opening up. So if you are trading with time spread, you have to get used to it, and also you have to get used to the fact that data in the last couple of days does not tell you anything. So if you will remember these data numbers, this will not be the case for tomorrow. These are not real numbers, and it's not the fault or it's not a bug in the Thinkorswim Analyze platform. Every single platform shows you the same thing because they cannot predict what the implied volatility skew between the two legs will be for tomorrow. That's why data is most of the time misleading if you are approaching expiration, and right now it's approaching expiration in the next 4 days. So after all that, let's look at what would have happened if I did this adjustment as we did it in the last couple of recording, because we thought or there was an assumption that the market might turn around here, and the turn did not happen, but still they are kind of okay, a little bit above the break even or above water, because here I created a diagonal spread, a wider diagonal spread with 10 wide strike, and it's going against me, but still it's below the short strike. So if the market stays here, that's healthy, and this one even more healthier because we only have like $5 in between the legs. So this is how they look right now, and it's interesting to see how this will change, and I will show you how the next coming days will change the IV skew of the time spread and how it will open up. So tomorrow one event risk is CPI, and after tomorrow PPI. They both can move the market significantly, and both reports are published before the market opens, so it will be interesting to see how the SPX responds to it, because the market assumption, if the CPI is better, that there will be a definite rate cut. If it's worse, then probably the market should sell off, because then the assumption tells the market participants that probably the Fed will delay another rate cut if there is a surprise jump in the inflation rate. So let's see how it goes tomorrow. I will continue from here. I'm back again. It's Wednesday, and we can see a true gap down on the daily chart of SPX. And what we also see is that the market went below the HVL line, which is around 69.45. And the other thing that we can notice from yesterday's recording, that yesterday the highest put support was 6,875. Now it's only 6,800, which means that the hedging activity has put lower the put support level. So there is a small bearishness in the short term in the market of SPX, because we are below the HVL, and also the highest put support moved down since yesterday. So right now it looks like that this trend line is temporarily breaking. Let's see what the market holds for today, but this level can be like a support line if you only look at the technical side and not the GEX side. But below HVL, we tend to be more volatile. So this is a point where a trader needs to understand and watch the position and scale out or employ some kind of hedge if it's needed. Now let's look around the two scenarios and how they compare to each other. Without any adjustments, you can see that these time spreads are pretty forgiving, but because even the more directional time spread is around break even, and the diagonal spread is up money because the market just gyrated around this area, and the time spread is pretty good in terms of neutral movement. So right now both are up money, and if we had done the two adjustments in terms of making it more diagonal, this side and also this side, they are both up money. So this is around $300 and this is around $100 with the adjustments. So right now we can track these positions, and let's see where the market unfolds, because both of them are kind of under the tent. So if the market is going back a little bit up, then this can create more money. And since this is only a simulation, we can still ride these two positions, and let's see how the SPX will react. But if we only look at the technical side, there might be a bounce from these levels. If not, then probably the next put support or support line is 6,800, and we will see how the market will unfold in the next couple of hours and days. I will continue from here. I'm back again. It's still Wednesday, but I wanted to show you something that someone can do if wants to hedge the position. Right now, what you can see from the previous recording, that the market kept going further down, and we are definitely below the HVL line. So someone could do a position like this. Let's say we had done the adjustment, the previous vertical adjustment. Right now what I could do is buying a downside protection. So for example, buying this protection and this protection in here. That would create a complete downside protection, because if you look at the market going further down, you cannot make any loss here and here as well. There is no loss potential. The only potential that there is a loss is between the vertical spread and the time spread. So for example, this kind of value of that, as we call it, this would decrease with time, and this will also decrease with time. And the only risk we have right now is if the market stay in between the vertical spreads and the diagonal spreads, or in between this vertical spread and the calendar spread. That's the only risk if I make this adjustment on the downside, because on the upside it's kind of out of question. We have 2 days until expiration, so it's pretty safe to say that we will not go above 7,060 or here 7,070. So we have to, if I want to make this adjustment, I need to watch this area, because if the market stays here and lands at expiration at this area, I will lose the calendar spread, the diagonal spread, and also I will lose the hedge, because the hedge will also go out worthless if the market stays around 6,900. That's why if somebody is hedging like that for the short term, we need to understand how to wind down the hedge or scale out from the position. So let's say I put on this hedge, and let's see how the market is moving in the next couple of days. If it goes back up, fine. If it's not, then we will make a small profit. That's the point of the hedge. If I did not do this vertical adjustment, they would look differently, because there would be higher loss on the downside. But let's compare it with that and see how the market unfolds. Right now, what we can see on the chart, that it's pretty ugly. I mean, it's pretty ugly going down. So as you can tell, this technical level clearly did not hold the price moving down. So the next put support is 6,800, which is pretty far from here, around 90 points. Let's see how the market unfolds. I will continue from here. It's still Wednesday, but I wanted to show you something since my last recording. Last time we put an adjustment as a hedge. 2.3 was the debit, and right now it's only 1.6 because the market is correcting back to the upside. So what I wanted to show you, that how a hedge can be a drag on the whole strategy. Right now it's around $60–80 in loss, and if the market stays around here in the next couple of days until Friday, the whole thing will become worthless, because the put spread will become worthless, and also the calendars. So this is creating a sag, a drag on the strategy itself, and this is called the value of that we are even seeing further down. I wanted to show you this effect in the next couple of days, just as an educational stuff. And on the other side, what we see is that because this is in a more of a profitable state, the diagonal itself, this is not as big of a drag as in here. But if the market stays at this level and will go back down, then the spread, the hedge will make money, but the hedge has to be under 68.95 to make money. So if it's between the two spreads, it will create a drag on the strategy, and it's very interesting to see, if you have never seen it before, that how it can create a drag in this part of the strategy. So let's see how this hedge position will affect the whole strategy in the next coming days. I will continue from here. I'm back again. It's Thursday. Let's look around what the market has been doing. What you can see on the daily chart is that yesterday the market bounced back nicely from this HVL line. As you can see from this red candle, there was a bounce back from the HVL. And yesterday we went below the HVL line, so we were in a negative GEX territory for a couple of hours, then it bounced back. Right now we are again above the HVL in a positive GEX territory. And as you can tell, the 7,000 is the next core resistance on the upside, and we only have 1 day until expiration. There are also notable differences since yesterday. For example, yesterday the put support was around 6,800. That was the main put support. Right now it went above 6,875, which is more of a bullish sign. The put pricing skew was above 110 yesterday. Right now it's 85, so the put pricing skew decrease also means that the hedging pressure became lower since yesterday, and also IVR has been decreasing since last day. So these are the market context information, and let's look around the strategies and how do they compare. We only have 1 day until expiration. Time lapses are pretty fast moving structures if we are very close to the expiration. So I usually tend to close these around Wednesday, latest Thursday, but for simulation or scenario purposes, this is good to see how they behave. So if I had done no adjustments, they would be both profitable. But as you can tell, this is a much more profitable strategy at this market context because it has around $600 with the same debit, and this has only around 250 or 300 as a profit for the same debit. Okay, that's one thing. The other thing that we did this vertical adjustment, they are still profitable if we had done the adjustment. And then yesterday I showed a hedge, a potential hedge adjustment. If I wanted to hedge the position in case of the market falling down, both of them would be profitable. But yesterday I also mentioned that this value of that will decrease. And if you compare this area around like $400 or something like that, if I move the mouse in here, that says around, yeah, a little bit below 400 would be the max loss if it stays here. But actually this will change for tomorrow. And yesterday I mentioned that this will increase in terms of the loss that someone can make if the market stays between the calendar spread and the hedge. And this is what we are seeing right now, that the vertical hedge that was put on yesterday was a debit of 2.3, and right now it's 0.50. So it almost lost the complete value because the market shifted back up, and there was also a volatility decrease around 6% on the wicks, as I can see it on another monitor in here. And the other thing is here, obviously this is in a much better situation with the hedge as well because of the initial profit also higher. But you know, hedge always costs money. Usually people buy hedge to protect the profit. Right now the hedge costs money and decrease the profit. And if it was a live position right now, I would close them down for sure because we are on a Thursday. But for simulation purposes, I would like to keep it open until tomorrow so that you can see how they behave. And you will also see this value of that and how it changes. Without the hedge, they both look great, but this has a much higher unrealized profit. If the market is going to go until 7,000, which is probable because of the core resistance and how the market shifted from yesterday, then both of the strategies will max out around 7,000. So I would like to show you how it's going tomorrow. I will continue from here. I'm back again. It's Friday, the expiration day. If we look at the daily chart of SPX, what we can see is that the whole GEX profile narrowed because we are on a expiration day, and the last day is usually a narrower day than before because of the time value of options and how the GEX moves. Right now, what we can see is that the market is above the HVL line. Not much is going on. Actually, the market opened in like 23 minutes ago, and let's see how the positions compare. Without any adjustments, the diagonal spread is in a profitable state. Calendar spread is around break even. If we had done the first adjustment, the vertical, also diagonal is much better, and with the hedge, which is important and very interesting to see, is that the whole value of that, this part, has increased since yesterday, because if you look at my previous recording, it was further from the 500, the minus 500 on both sides. Right now it is almost at minus 500, and as you can tell, if you compare my previous recording, the whole body of the calendar spread and the diagonal spread became narrower. They sink. The top of the time spreads also sank from these levels because it was higher previously. So when I think about sinking, I mean this peak of the strategy became lower from previous levels. So that's what I mean about sinking. And what you can also see how we approach expiration is that the closer we get to the final minutes, they get more narrow and narrow and narrow. So for educational purposes, I will shoot another video about how they look very close to expiration. So right now what we could see is that both hedges are almost worthless, but the diagonal spread is doing better. That's why I'm telling all the time that I tend to close time spreads latest on Thursday, because on Friday it's kind of a lottery ticket where the market will go and how the whole thing can collapse. If you have a hedge and you also have a time spread, the hedge and the time spread is very dangerous if the market is staying in between them. That's why it's called the valley of death, because this valley of death increases day by day. No expiration graphs will show you the exact truth that will happen at expiration, because the whole thing morphs until they both expire. So this is what you have to keep in mind, that whenever you see an expiration graph with a hedge and with a time spread, they don't stay the same during the lifetime of the trade. So right now what's very bad for the position, if the market decides to turn down and go to, for example, to 69.20, which is the put support right now, because if we go to 69.20, then this is exactly where the market will end, around here, which is the highest, like in this part, the highest, almost the highest loss state around here. So that's not good. The market should go up. As it says, we have a positive data on both sides. So the market should go up to make money at this stage. So with a hedge, you should not hold it until expiration. You have to at least scale out or roll or do something just to adjust the position. And that's why I wanted to show this to you in the last day, how they morph, how they change. We still have 6 hours to go. I will shoot another video when we approach the final hours, just to show you how the whole thing changes. I will continue from here. I'm back again. It's still Friday. We have 5 minutes until the market is closing, and right now what you can see is that the GEX profile is very narrow. That's absolutely normal, because we are in a 0 DT GEX profile. If I change it to 15 minutes, you can see it better. Now let's look around the strategies and how they look 5 minutes before the close. What you can see is that the whole structure became narrower. than in the previous recording. And if you look at this peak is at a lower price level than it was previously, because the whole thing sank. This is a drag that happens on the last day if the market is not in between the two break-even prices and in the tent. If the price is in the tent, it tends to open up. Right now, this is right in between the hedge and the calendar spread. This is also between the hedge and the diagonal spread, and this one also became much narrower. And let's look at the previous or original positions, what would have happened if I did nothing. Both of them would be obviously in a losing state, but yesterday was a much better profitability, and that's why I wanted to show you this as an educational lesson, that on the last day, calendars and hedge combined with calendars change a lot in terms of the expiration risk graph. So that's why it's important to scale out from these kind of positions. And with the first adjustment, they would be both in a losing state, and this one as well. But if we had adjusted it, we would have closed them down in a profitable state. So if you have any questions, just let me know. Thank you for your attention. Take care. Bye. Thanks for watching. If you haven't yet, please subscribe and check out our other videos. You can always find us at the links in the description. Trade safe out there.